Thank you for this kind introduction. Ladies and gentlemen, it's my pleasure to be here. And as you mentioned that I'm coming from my hometown, Würzburg, and speaking in the afternoon, this reminded me of days when I was still teaching at the university in Würzburg. There was a famous scholar, Brentano. In his memoirs, he wrote about his studies, etc., his life. And he was studying law and economics at University of Frankfurt toward the end of 19th century. And he fell in love with a young student, and she decided to move from Frankfurt to Würzburg. So, of course, he joined her. And then his chapter on Würzburg starts with saying, "In Würzburg, I learned nothing." And he describes the bad situation of the university. And he said, on top of that, there was a professor of public finance. We were a small group of students, 4 or 5 of us. And most of the time, my colleagues fell asleep. And one hot and damp afternoon, I also fell asleep. And when I woke up, the professor had fallen asleep too. I was more warned that after a long day, I suppose good lunch, there's a danger that some of you might share this experience. But you can be sure during the next 1.5 hours, I will not fall asleep. Any crisis, every crisis, gives a reason to think, why did the crisis happen? Why came we to this mess? And what should be changed to avoid that such a crisis is repeated in the future? So in this respect, a crisis is always also a chance. And I think it's no accident that the Greek origin of the word crisis has already these 2 elements. And I was told that in Chinese, the sign for crisis is composed of the 2 signs of danger and chance. Of course, in the middle of a crisis, we think of the dangers, not so much of the chance. But I think looking into the future, a crisis really brings a big opportunity to improve the framework, to lay the fundament for a better situation in the future. Joseph Schumpeter, the great Austrian economist, has framed his famous word of constructive destruction. Schöpferische Zerstörung. And if you look into history, in some respect we might say progress is always happening going through crisis. And some people even say that European integration was always improved, enhanced during and after a crisis. I think this is not an argument to willingly prepare into going into crisis, but I think we should consider that. So what I will try to do during my speech is first, before I come to the challenges for central banks, as the title announces, I will first explain the environment in which I see the challenges for central banks, then coming to challenges for central banks worldwide, and after the introduction and assuming your expectations, I cannot avoid talking about the crisis of Monetary Union, and Mr. Schoch told me that expectations are going in this direction. So, okay. It's obvious and well known that the crisis which is behind us, question mark, was the worst one after Second World War I. In many respects, there are comparisons with the crisis of 1929 and the following years, the Great Depression, and comparing the present situation and the years aftermath of 1929, collapse of banks, etc. We can already say that this time the world, we have done better. We have done better. One reason for that is that politicians, governments understood that what has happened after 1929 should not happen again, which is starting a war all against each other. Just to give one example, in 1930, the Americans tried, and this reminds us of the problem of global imbalances, the Americans tried to create hindrances to further imports and foster exports. So the so-called Smooth-Hawley Act was signed, and the ink of the signature of President Hoover was not yet dried when other countries already retaliated. The Smooth-Hawley Act increased American tariffs by 20% across the board. And before that really came into effect, other countries had already retaliated. And what started also at that time is a currency war, competitive devaluation, one country following the other. I think this danger is not yet over. This danger is not yet over. The Americans are blaming the Chinese, etc. So we have to see how we will proceed in the future. But different to 1929, what happened this time, when the crisis broke out in 2007, after that, the leaders of the 20 most important countries in the world met for the first time a summit to try to act together and not against each other. And this is a continuing process. I'm normally not in favor of big international events, etc. Mostly it's not coming much out of these meetings. But I think this time we can say that the heads of states and government have really cooperated in a way which is much, much different from 1929 and following years. Is the crisis over? On the real economy, it looks like. There are global economies growing again, with a strong element in Asia, but countries like Germany have come like the phoenix out of the ashes. The Germans are still wondering why they had this V-shaped turn after the strongest recession after Second World War, the strongest recovery ever, from minus 47 in 2009 to plus 3.6 in 2010. It's something which has never happened in Germany, and people are still trying to explain was it just sheer luck or to what it is due. So, in real terms, the global economy is in much better shape than 2 years ago could have been expected. On the other hand, the financial sector is still not, it's in better shape than 2 years ago, no doubt about that, but still adjustment is not yet finished. We are far from that. And the new financial infrastructure, the Basel III regime, etc., will impose a lot of adjustment problems to the financial sectors. And supervision will be strengthened, regulation will be tightened, so the adjustment to that in the middle, coming out of the crisis, will be a huge challenge to the financial sector. I think we must not forget that the crisis which started in mid-2007 is something very, very different from recessions we have seen over the last 50 years. There is a famous book, famous in the meantime, by Reinhardt and Rogoff, the American economists, with the title, This Time is Different. And it's interesting reading because they are comparing crisis over a period of 800 years in 66 countries. And the title of This Time is Different is coming from the fact that, remember, in the late 90s of last century, early 20s, etc., the financial world was more or less totally convinced this time is different. Markets are so sophisticated, risks are distributed across the world, so contagion will be minimal if something happens. And some cases like, what was this hedge funds, I think, Amaranth? No, Amaranth, yeah. They failed, $8 billion disappeared, but it had no consequences whatsoever. And all the comments in the financial press were, see, our system is now, financial system is not more fragile, it's much better prepared to meet collapses of individual institutions. And this was just an illusion. It was not different. It was not different from the past. And Reinhardt and Rogoff have identified the common causes of all these crises in 66 countries over 8 centuries. It was an unusual increase in private and public debt. This is a common feature of all major crises. And in another paper which Reinhardt presented in Jackson Hole in summer this year was that coming out of such a crisis, not of a simple recession, of a crisis which was accompanied by collapses of asset prices, big bubble burst. Coming out of such a crisis takes much longer than coming out of a normal recession. Why? Because the crisis, the collapse of asset prices, destroys balance sheets of almost all sectors. When housing prices collapse, it's not only banks which are getting into trouble, it's always also private households. If private indebtedness, like in the US, with credit card use, etc., goes to substantial dimensions, it will take quite a long time until household balances, if we take it this way, are restructured in a way that consumption is saving is again on a sustainable path. Which implies that for the US, we should expect moderate growth for some years to come. In a country in which, for a time, private consumption was 70% of GDP, and it was financed to 1-2 percentage points just by increasing debt of private households, it'll take a long time until this will be corrected. So we should be aware that the consequences of this crisis will continue to have a dampening effect on the world economy for some time to come. Central banks, after the outbreak of the crisis in August 2007, have reacted immediately. They have reduced the interest rates to the lowest level ever in history. In many cases, close to zero. The European Central Bank has reduced its main refinancing rate to 1%, but de facto, the interest rate at which banks can get liquidity is substantially lower. So interest rates are to their lowest level, And this raises the question, what can central banks do when they reach the zero bound? Because you can increase interest rates, nominal interest rates indefinitely, but you can reduce it only to zero. Zero is the lower level, the lowest level. It's the so-called zero bound. But it was discussed before and it is now implemented. Monetary policy is not without weapon when the zero bound is reached. Central banks can use many measures which were called unorthodox measures. And quantitative easing is a major element of that, which means central banks just buy assets. Just buy assets, and by that, they, on the one hand, can increase liquidity. On the other hand, they enter into quite a number of problems. And the big discussion for the US is to what extent will this second and third round of quantitative easing have positive effects. On the interest rate, should be minimal. There are several calculations with different models which indicate that the interest rate effect, long-term interest rate effect, might be 0.2, 0.3% at a maximum. It's minimal. And Bernanke, the chairman of the Federal Reserve, recently in a speech in Frankfurt has stressed that his interpretation is mainly that the portfolio shift is the most valuable element in that. What does this mean? When the central banks buy assets from, let's say, government bonds, from banks or private households, private investors, there's a portfolio shift in the balance sheet of the private sector which substitutes bonds by cash. So liquidity is increased in the private sector. But the question is, what will the private sector do with that liquidity? Here, the central bank has no more impact on what the private sector might do. So we see on the one hand an explosion of the balance sheets of central banks worldwide, especially in the US, UK, some extent in the European Central Bank. But at the same time, so central bank money is out of kilter. But money, as measured by narrow aggregates or especially by broader aggregates, is not rising much, if at all. Which means that the so-called money multiplier, which translates central bank money into money and credit, is not working. And this is typical in a crisis. So the big question is, what will central banks do once the situation changes? This is a big challenge, one of the biggest challenges, that central banks, for the time being, are still doing crisis management. But then the question is, when is the appropriate time for exit? For exit, which means either increasing their interest rates and or stopping quantitative easing and reverting it, because they are sitting now on a huge bulk of assets. And the big problem is once the economy turns, private credit creation starts again, the money multiplier works, and then there is a risk of inflation with all this liquidity. Not before. But in the context of rising interest rates, selling all these assets will increase the impact on the upward movement of long-term interest rates. And look, especially in the US, this will be a moment when the central bank will get in deep conflict with politics, with the Congress and Senate, because certainly politicians and also the industry might not like interest rate increases. So this will be a tough time for central banks. This is a big challenge, and independence of central banks is really at stake. It will be a tough moment. And to decide to exit from this extremely expansionary policy. Not too late and not too early. Too early would endanger the recovery, too late would create inflationary problems. So deciding on the right, appropriate time of exit is an extreme challenge for central banks in the Western world. But at the same time, crisis management should finally give way to going back to normal monetary policy making. And here, the big challenge for central banks is what should be the appropriate strategy which will prevent the build-up of a crisis as we have seen it. And here, one can say that academics, theory, research, and central banking is still divided in two camps. The dominant view in the US for many, many years was expressed especially by Alan Greenspan, but most members of the Federal Reserve Board had this view, which I call the Jackson Hole consensus, because in the famous conference in Jackson Hole at the end of August every year, there is a meeting of leading central bankers in the world and leading academics. It's a relatively small group, smaller than this audience here. The Federal Reserve always has explained that central banks first should not try to target asset prices. Second, they should not try to prick a bubble. And third, once a bubble bursts, central banks should provide all liquidity to prevent what happened in 1929 and the following years. So I would say on this, there's hardly any difference of opinion. I had so many discussions with my colleagues of the Fed during the years of my term at the ECB and beyond. This continues. Of course, central banks cannot target asset prices. They have no instrument to target house prices, to target stock prices. This is not possible. So this is obvious. Second, central banks should not try to prick a bubble. Once a bubble is like that, blown up, and the central bank would try to prick the bubble, it would have to increase interest rates very strongly. And then the bubble bursts, and the economy is in shambles. Imagine for a central bank, reputation, political support, this would be an absolute disaster. Of course, central banks should not do that. And third, once a bubble bursts, we know from the experience of the Great Depression in the 20th century that the crisis was worsened by bad monetary policy. Milton Friedman and Anna Schwartz have demonstrated in their big book on history of monetary history of the United States that the Fed has not understood at that time that they were looking on central bank money, but not on the multiplier. And so the monetary policy was much too tight and has aggravated the situation. So this is all clear, but my question always was, not just now after the crisis emerged, but before, is this all? If this is the message, how central banks should deal with asset price developments, it implies an absolute asymmetric approach. The message would be, as long as asset prices go up, central banks say, this is not our business. Once they collapse, central banks have to come to the rescue. It was the famous Greenspan put. And this, of course, is an invitation to take greater risk, because finally central banks will bail out banks, etc. This is a consequence of that. And if you think about the last two cycles of asset price increases, this is exactly what we have seen. The central bank has provided liquidity, reduced interest rates, etc., and by that has prepared the ground for the next bubble, which has become greater and greater. So this, I think, is, for me, was always a totally dangerous and misleading strategy. So what should central banks do? Because criticizing is not enough. Here, a strong argument just to personalize it, my colleagues in the Fed and many academics was, central banks have no special knowledge about the appropriate valuation of asset prices. How should central banks know better than markets? And as a former academic, for a while, I was convinced by this efficient market hypothesis and thought myself, central banks have a feeling something might go wrong, but what is the basis of that? Do we have models to see that? And speaking here in Switzerland, this reminds me of a personal meeting with Alexandra Lamfalusi at that time, the managing director of the Bank for International Settlement, and we know each other since long. So in a private conversation, he said to me, Otmar, why should we be so pessimistic? We know that in some cases house prices are exaggerated, etc. And I thought, Alexandra, but you see, all the models are telling the prices, all the information which is available, why should we do better? And this meeting and remark has triggered with me thinking about it, and I have not stopped. And then what I have done is I've talked to market people, traders. And then something which is obvious, I could have known before. Then I learned they exactly knew that a bubble is emerging. They were convinced this is a development which is not sustainable. But first, and some told me so, one guy one day, it's long ago, told me, Otmar, you are right. And I think you are right. But if I would do my business on this hypothesis, I will be fired before I'm proven right. Because this is a time when asset prices go up, when big profits are made probably over a much longer time than everybody expects. And if you go to your boss, when you have to deliver quarterly results, even twice a year results, etc., all your colleagues make profits, and you say this one day will collapse. It doesn't help if you are proven right 2 years later or so. So, and everybody, of course, in this game has the illusion. We know that will not continue, but I will be the first going out of the door. And these two things come together. So central banks should be more forceful in analyzing if asset price developments are sustainable or not. And in the meantime, there are quite a number of models and tools. What we have done in the ECB is we have just compared asset prices and rents, asset price developments, house prices and rents, asset price developments in the past, price earnings ratios, etc. And if everything goes out of kilter, then there's indeed at least an indication that a collapse might not be so far away. And here comes something which is very important for central banks. Studies by the Bank of International Settlement and also by the ECB, we have, I'm always saying we still, till the end of my life probably, at the ECB, we did quite a number of studies, and the result will not be surprising for you. There is probably not one single bubble in the past which was not accompanied, if not preceded, by strong increase in money and or credit. You might say it's obvious, but this knowledge was lost. This knowledge was lost. And here comes, I think, an important message for central banks. Monetary policy strategies must, of course, include analysis of all relevant factors. And money and credit are important, extremely important indicators. When we started at the European Central Bank in June 1998, and we had to consider a few months later, 1st of January 1999, we had to start with monetary policy for an uncharted territory. Monetary union of these 11 countries, nobody had any idea what it is about. And it's a new central bank, a new currency. And the question was, should we have a strategy? Or should we just start on January 1st and say, we do not know much, but trust us, we will try to do our best. This would have been an honest approach, but probably not the best one. The markets would have been confirmed in their prejudice that this small new institution is totally unable to fix this thing. So, of course, this was not an approach. So, and I had collected a small group of economists from my department's research and economics, and so I said, we need a strategy, but what should it look like? And people expected from me, coming from the Bundesbank, that I would be in favor of monetary targeting. I was strongly against. Why? Because for that you need stable relations between central bank money, M1, M3 or whatsoever, and with a new currency, you don't know how savers, investors would behave. Would they trust the currency, etc.? So there could be structural breaks, which were dealt in a famous article by the Nobel Prize winner Robert Lucas many years before. So no monetary targeting. But, and I will never forget this moment, I said to my my colleagues, I'm strongly against monetary targeting, but we should give and credit a prominent role in our strategy. Because inflation, as Milton Friedman has coined it, is always, in the end, in the longer term, a monetary phenomenon. And central banking obviously has somewhat to do with central bank money and credit. And this must be an unavoidable, indispensable part of a sound strategy. So we have designed this so-called two-pillar strategy, which includes monetary analysis. And monetary analysis means, in a very broad sense, looking into all aggregates, into development of credit aggregates, etc., making it part of the analysis before monetary policy decisions are taken. And I did not attend, of course, anymore, and not only because I was in the train this morning in the Governing Council of the European Central Bank. Certainly, the proposal of the board, what should be done, was based on exactly this two-pillar strategy, looking into developments of the real economy, wages, fiscal policy, etc., exchange rate, and clear and encompassing analysis of money and credit. And on the basis of that, then happens the so-called cross-checking, comparing what do the messages coming from these two analyses, economic and monetary analysis, tell us, and bring it together in one unified approach, and the consequence is today we should do this or that. So I would claim that the ECB indirectly has already taken into account developments of money and credit, and thereby also, to some extent, developments of asset prices. And this is now something which is discussed worldwide, how to do that. How to do that. And it was interesting for me to read and hear how some colleagues, former members of the Federal Reserve Board, are now saying probably we should consider asset price developments more closely, and if they are accompanied by strong credit growth, the central bank might have a case. In a contribution discussion at the ECB conference a few weeks ago, I said to a colleague presenting this result, I said, welcome, where we have started 10 years ago. So I think the world of central banking is now dealing with this challenge, and the question is how to integrate it, because financial stability has become part of the mandate of central banks, if they wish or not, which was not the case before. And this is anything but simple, because the peak of the reputation of central banks probably was in the middle of the 90s, early 2000, when inflation was low worldwide, growth was quite strong. It was called the Great Moderation. And the question was, it's a kind of Goldilocks economy, and the question was it due to favorable circumstances, or was it due to improved macroeconomic policies? And central banks have claimed it's to a great extent the result of our much better policies than in the past. I would subscribe that, but at the same time, in the context of low inflation, asset price bubbles emerged. How can this happen? The mandate of maintaining price stability is a mandate to maintain consumer price stability. All indices which are used for that are consumer price indices. And asset prices are not included in that, and rightly so. So if we live in a world in which inflation as measured by consumer prices looks flat, looks stable, central banks following an inflation targeting approach and not looking into money and credit say everything is fine. We do the best monetary policy we can, and ignoring that at the same time the additional liquidity provided by relatively low interest rates goes into increases in asset prices, stocks, in house prices, removing almost all differences in interest rates. What was also an element of that was that if you look back, the spreads between many kinds of assets with very different risks had almost disappeared. Today it looks crazy. It was already crazy at that time, that the government's bonds from several countries, Africa, in Asia, etc., with names hardly known, did not bring more interest rate than bonds from Switzerland. It's a special case, let's say from Germany or other stable countries, because the liquidity triggered a hunt for a return, and where there was still some interest rate differential, money went there and reduced spreads. So this was a situation which was ripe for a correction, and the longer it lasted, the more it contributed to this blowing up of the bubble. This has to be avoided. So central banks, I think, should take an approach which goes in the direction of what is called leaning against the wind, to be much more cautious in their policy, and certainly not neglecting the development of money and credit. But this is a global challenge, because asset prices worldwide are now driven by global liquidity. And even the European Central Bank, the second most important central bank in the world, cannot control global liquidity. And what we will see, and this is a big challenge, is that also in the context of different timing of exiting, we might have quite a number of crises in foreign exchange markets, because they will react. They are starting also reacting to different approaches of central banks. So I think if this is not done in a reasonable way, we might have quite some turbulences in foreign exchange markets. And certainly central bank with monetary policy cannot do everything. However, the argument that the interest rate is the only tool is a too blunt tool to deal with financial imbalances, I think is too simple. The argument, especially of the Fed in the past, was even if a central bank would try to lean against the wind of emerging of a bubble, the interest rate increase which is needed to prevent that would have such strong negative consequences on the real economy that the costs would be too high. This is not a convincing argument, because in our world of sophisticated financial markets, of highly leveraged relations, also minor increases in interest rates by central banks might have major impacts on the term structure of the yield curve. And if central banks signal that they are going in a less expansionary direction, I think this would also influence investment decisions of private investors. But central banks must not be left alone in this context. And here comes something also into the play, which, looking back, is again almost incredible. In the past, supervision was supervision of individual financial actors. But the systemic risk which might emerge if one single player collapses because it is too big to fail, or too connected to fail, this was not considered. In all these financial stability reports, etc., the systemic risk was not really dealt with. And this is now understood that this cannot continue. And for the European Union, I was member of the so-called de la Rosière group, and we have suggested to establish a European Systemic Risk Board. We are aware that Switzerland belongs to Europe, but it's also called European Monetary Union, and so I apologize for that. It's an approach which should be applied for not just Monetary Union, but for the 27 member countries of European Union, because this should be at least become one day a single financial market. And the European Systemic Risk Board is established now at the beginning of this year. It works under the domain of the European Central Bank, and the idea is that this board tries to identify systemic risks. Not risk of individual actors, but of risks which emerge if connections, etc., become too complex, too large, exposure, etc., creating a risk for the whole monetary area or for the European financial market, the market of the EU 27. And the combination of this systemic risk assessment and monetary policy would lead, hopefully, to a cooperation of central banks doing monetary policy, deciding on interest rates, and identifying risk coming from the macroeconomic side, which would imply supervision, stronger regulation of individual cases, or also implying special regulation demanding more capital, etc., in cases of risks emerging. So this combination of macroeconomic risk assessment and monetary policy is one of the big challenges. And the same is true in the US, how to deal with that, make the central bank responsible for everything, to have it in one hand, or better, to have separate institutions, which to some extent is my preference, because it brings central banks also into very difficult political turf. And for me, a central bank should not be responsible for closing individual banks if needed. This is a policy decision, or saving a bank, because saving a bank is in the end investing taxpayers' money. And the central bank must not do that. This is a decision of the fiscal political authorities. But cooperation in this field is one of the big challenges. And now let me come finally to the situation in European Monetary Union, which is a challenge not only for the European Central Bank, but especially so. Let me be short, and hopefully in the discussion we can, if you are interested, extend that a bit. Let me say first, this crisis of monetary union is anything but unexpected. For me, the crisis started, the way to the crisis, years ago, one might say from the beginning. And this is not an ex post statement. I gave many speeches when I was still in office, and sometimes my colleagues ask me, Otmar, are you not in favor of the euro? Are you critical of the euro? I said, no. I want to confirm it, to make the fundament safer. But for doing that, you must first address the problems, and not just have illusions. Optimism alone optimism is fine, but it must be based on sound policies, and for that, you must identify the weaknesses. What were the weaknesses? The biggest weakness was from the beginning, you know it from this country, and from many cases in history, in the end, stable money and solid public finance must go together. European Monetary Union is not a state. It's a group of countries which are unified by one single monetary policy, but in many respects, governments remain independent. They are still states, France, Germany, Italy, with the government fiscal policy responsible to its voters. But to make monetary union work, such a unique constellation, one central bank, one single monetary policy, and 11, now 17 countries, independent countries, this is an totally unusual constellation, unique in history. And the idea was that we have the Stability and Growth Pact to control fiscal behavior by national governments, by a European body. So independent governments are free to increase taxes, reduce taxes, etc. But on the fiscal deficit side and indebtedness, there are European rules. This is the idea of the Stability and Growth Pact. And I said it before, hopefully it works, because this European jury is a jury of potential sinners, making a judgment on actual sinners. For the time being, there are only actual sinners, almost only. But this is a political problem in this context. Could it work? The biggest blow to the Stability and Growth Pact was by France and Germany in 2003. And it's more than an irony that the country, Germany, which insisted on the Stability and Growth Pact as a condition to go into monetary union, was the country which violated the pact in the rudest way. This was a kind of death blow to the pact. And unfortunately, discussions on restructuring, improving, strengthening the pact were not successful. So this is a big weakness of the framework. But beyond that, there were macroeconomic divergences which, as I said a moment ago, emerged right from the start. What happened was that unit labor costs started a diverging course. Unit labor costs as an indicator of price competitiveness. Take, for example, Portugal. Portugal had an increase in unit labor costs accumulated over 10 years in relation to Germany of 30%, 3-0. In the past, with an independent central currency, the escudo would have devalued by, let's say, 30%, 40 or something like that. And this would have corrected, so to say, the increase in internal prices. Within the monetary union, this cannot happen anymore. So a country like Portugal, Spain, Greece, others, lost competitiveness within monetary union year per year per year per year, because it was continuing. If it's 1 year or 2 years and later corrected, it doesn't matter so much. But it was just a linear trend, And this was something which didn't go unobserved. I vividly remember when I accompanied First President Wim Duisenberg to Eurogroup meetings, already 2 years after the start, we have pointed to this fact. And Trichet made it a personal mission. We have admonitioned him with graphs and tables for every second meeting of the Eurogroup finance ministers. So this was something which was obvious, and nothing happened. And second, we had also developments in some countries, especially in the housing sector, which totally went out of control. And here again, this was not something which went unnoticed. Take the case of Spain. We at the ECB, every month, in our monthly bulletin, etc., have referred to this development. The Banco de España has warned its government to do something. Monetary policy in the monetary union cannot react to developments in individual countries. So it was not a case for the single monetary policy, for the ECB. It was a case for national governments, in this case Ireland, Spain, to do something about it. And there are tools. And it's incredible. It was not only that Spain and other countries didn't do anything against the emergence of this bubble. They have contributed to that. There were tax incentives. At a time when house prices exploded, there were still tax incentives to buy more houses. This is what I mean when I say this was a crisis which had to be expected. I must say the dimension, I was shocked. I think nobody was aware of the dimension, for example, in Greece, also because they cheated on the numbers. So, to conclude, what can be done? In MU, in monetary union, there's now, so to say, a struggle between two approaches. One approach is transfers. The solidarity of the rich should help the poor to deal with their problems. To some extent, this is happening. To some extent, it might be unavoidable, but this, of course, is creating at the same time moral hazard, because if you can trust that once you get into trouble, you are bailed out, this is an incentive certainly not to do reforms, but to trigger transfers. This must be avoided, and for me, this is the biggest political risks of multi-union Europe, that people in the end will not accept that their taxes are transferred to other countries without saying, and now we have this discussion about pension schemes, etc., all that. And this creates almost hostility, not just in Germany. And it's not a case of rich versus the poor, it's a case of those who behave well against those who violate the rules. Because this kind of transfers triggered by macroeconomic imbalances are triggered by misbehavior, which can be done also by richer countries, and might imply transfers from poorer countries. So this is something which is extremely dangerous. For me, the biggest political danger for the cohesion of multi-union. What is the alternative? The alternative is strengthening the framework. Strengthening the framework, and strengthening the framework means really applying the rules of the Stability and Growth Pact, not accepting that countries continue with increases in unit labor costs, etc., losing competitiveness year per year, and certainly making all financial help absolutely conditional, only against strong reforms. And you see, market discipline is in the end the best tool. The Portuguese government yesterday day before was extremely concerned how the market would react to this need for, it was a small sum of 1,500,000,000 bonds, short-term bonds. It went well, and I think it went well because the government at the same time, in the meantime, has decided to implement a very severe reform program. And market discipline is now working very hard on all these countries. And markets have to be convinced that the commitment is credible. It's not just 1 year or a half year, it's a continuing process. And this is the challenge for all member countries of multi-union. Ladies and gentlemen, as far as I can judge, nobody has fallen asleep. And before I do, I ask you to raise questions, and I will stop here. Thank you for your attention.
Well, I think this is just a great opportunity for us to have you here for about 10 minutes for discussing specific issues. So please, feel free. There are so many hands. Well, great. He was the first, then we will be with you. Please, maybe you can introduce yourself very shortly, please.
Bruce Pollack, C Major Holding. It is said there are two certain things, death and taxes, even in Switzerland, this is the case. And after hearing you speak, I'm adding a third case, and that is probably some break apart of the European Monetary Union in some form or other. That would be the third. You mentioned two possibilities, transfer payments, stricter controls, and the third is a restructure of the European Monetary Union. What will it look like in reality? Thank you.
You are right. This is the third possibility, but I think it's a pure hypothetical one. Why? No country will leave, because leaving monetary union is committing economic and to some extent political suicide. The fiscal burden would explode. Who would buy bonds from a country which was forced to leave monetary union? So I think it's a totally hypothetical case. We know that one should say never, never. But I think it's such an unlikely event, and sometimes reading some media, especially articles in a newspaper with a strange color, sometimes I have the impression that they are getting very angry when EMU continues to survive. But it will survive. For me, the question is not, will the euro disappear? The question for me is, what kind of euro will survive? Will it remain a currency based on stability? Or will it be a currency based on average approaches of price stability, etc.? And what in this country is also relevant, a few months ago I gave a speech here. And I shocked the audience by saying, purely hypothetical, for a moment, if you allow me to ask, consider what would happen if Switzerland would participate. And
well, that was the start this morning. This question was the start this morning, yeah.
Yeah, so I think much more unlikely is that the euro will disappear. And this country, of course, when we started, before I was at the Bundesbank, and we had close relations to the Swiss National Bank, and before the start we had meetings, they were very interested in what's going on, and it was absolutely clear the country in which the central bank and bankers in general pray every day for the stability of the euro is this country. Because for a moment, think what would happen if the euro would collapse or would becoming a weak currency. You would have more investment, financial investment here, but the industry would disappear. The exchange rate would go through the roof. So in some context, the stability of the euro is an issue which goes much beyond monetary union. It's a matter of, it has changed the world of finance worldwide. For Asia, it's also extremely important to have an asset to diversify, for central banks, for example, their assets. If one would one like to put all eggs now in the dollar basket? I think certainly not. And once the attention, forgive me, the Europeans, I mean the 17 of monetary union, have more or less solved their problems, then the attention will go to the direction of the US and UK, in which fiscal policy on average is in a much worse shape than on average in the euro area. The euro area fiscal problems are problems of individual countries. On average, the indebtedness of the euro area countries, on average, it's substantially lower than in the US and in the UK. So the world is now focusing on problems here, and unfortunately, there are good or bad reasons to do that. But from a global perspective, I think it's very clear that the euro will remain and will continue to play a major role in international finance.
And you seem to be very happy with these answers, aren't you? see your face smiling so much. Okay, so we have the second question here. Can you raise your hand so the lady behind will see you? Thanks.
Yes, Professor Issing, I have a question with regards to the first part of your speech. You mentioned the quantitative easing program of the Fed and the substantial amount of assets that the Fed has purchased in the meantime, and the problem that they may have to sell them at some point. But one alternative would be, of course, to just keep them on the balance sheet and let them expire.
From a portfolio perspective, this might be an obvious advice. But consider a situation in which the economy is getting stronger and stronger. Credit growth in the US is really jumping or strengthening. Then the other side of the assets in the Fed is cash. And the big amount and the explosion of the balance sheet of the Fed reflects the increase of central bank money in the private sector. So far, this central bank money has not triggered an inflationary problem because it's more or less held in cash. But as soon as on the basis of that banks start to increase credit, etc., then you have credit expansion and monetary expansion, which hardly can be controlled only by increasing interest rates. So the less you would sell assets, the more you would have to increase interest rates. So this will be a trade-off, difficult decision. So if the Fed would act just as a bank, hold it to maturity, of course, this is this aspect of not making losses. But a central bank in first place is an institution which should control inflation.
Thank you. Well, please. Can you just wait? Yeah, you already have your mic.
Yes,
great.
Hi, Dr. Issing. My name is Robert. I'm working from Credit Suisse. First, my question is related to the answer to the question of that gentleman. You said that it's impossible, but I think that, probability is low, but I think the key question is when a country decides to whether they belong to EU or EMU or not, I think it's a matter of benefit. They look at the benefit and the cost. But in the case of Ireland, if we look at it, what is the biggest risk if you pull out of the monetary union? Bank runs. Your bank cannot tap liquidity. It already happens. So for that, you take that one out. So there's one less cost left. So if you look at it, then when the incentive to get out is getting smaller, then there's a possibility they will decide, okay, we're not going to be part of EU, EMU. And also regarding that, the problems once country decided to pull out of the monetary, you have consequences. But I will point out to the counter-example, which is Iceland. Iceland is a good counter-example to the island, because if you look at it, Iceland did exactly that. The default on the debt. The bank's debt. Actually, Ireland's debt were actually, the public debt was very low before the crisis. But their debt got exploded, the government debt exploded because it assumes the bank's debt. So if Ireland decided, okay, let's say, because this is politics actually, it's political economics. If the government decided, okay, we're not going to guarantee the banks.
Well, maybe we just make a little time out and
okay.
give him a chance for trying to answer
my
your...
question is, to be honest with you, this has to do with, so I think the decision to bail out the banks or bail out somebody, or let's say, it's not based on whether they behave, because when you look at the government, actually did pretty well. They did not, okay. Okay. The question is...
give him a chance to react. He will come back to you.
It has to do with the transfer union. Because I think I think it is very, very, because I think I can understand the perspective because we're in the Germans. But you cannot have monetary union
now,
without...
time out. It's also a kind of courtesy towards our
because
keynote speaker. Now he can answer you. Okay?
No, no,
Is
because
that fair? Is that fair enough?
No, no.
Please, it's your turn. Okay.
I haven't put my questions yet.
Yeah.
No, my question
Thank you. It's really his turn now, okay? And you have a break later too. Okay, so just find each other, but now it's absolutely his turn. Okay.
I try to be a bit shorter.
Thank you.
Sorry.
First, I fully agree with you. To join monetary union, to stay in monetary union is always a comparison of costs versus benefits. But before joining, the assessment is different from after having joined. Because once you are in, you are member, have become member of a club, and you are seen as not being able to meet standards of a stability-oriented group, this will hurt your reputation for the future, for years to come. To recover from that, I think is something which, as far as I understood, was not included in your consideration. And second, what is obvious, what is seen as support for a country is to some extent support for financial institutions which have bought the assets of such a country. But this is also an element of something which was totally underestimated. This is the connection of the financial sectors. Spanish banks have, I think, 70 billion investments in Portugal. These are financial connections which go beyond what initially was considered, and bailing out of states and bailing out of financial institutions is sometimes hard to differentiate. But finally, the case of Iceland versus Ireland, I think it's not relevant. Again, once you have joined and you miss and you tell the whole world, we are not able to meet standards of a stable union, I think your reputation will be ruined for long years to come.
Thank you very much. Now another question. We still have about 4 or 5 minutes. Please. This one and then here, please.
Okay. You mentioned that you see the next problem in the currency markets. Does this only mean with China, or is there any other country where you see a problem? You said that Switzerland, we will go through the roof if currencies that money would come to Switzerland more. Could that be a problem, or where do you see the forex market?
On Switzerland, I made it very conditional. I said, imagine for a moment, triggered by your question, that the euro would collapse. Then the question is, where are safe havens in this world?
Bail out the Swiss National Bank at the end.
The Swiss National Bank, the other side of the coin is creating central bank money. So this does come with a high cost. And the Swiss National Bank, I have high admiration for the bank and for the people who are on top of it. I know them very well, no doubt about that. But so to say that the whole future of the financial world should be based on one institution, I think this is a bit overstretching, and they are certainly not looking forward to what you have in mind. But again, what we see, and you are part of it, you understand that much better than me. The whole world, financial world, is, so to say, reconsidering investments. How should we distribute, allocate, diversify our assets in this complex world through maturity, through currencies, etc. And in such a situation, I think even minor events could trigger huge investment adjustments. So this is a very fragile situation, and I think having a side of the dollar, another stable currency of worldwide importance like the euro is an important asset for the stability of the financial world.
Thank you. So there was a question here. Well, there was somebody raising his hand before. No? Oh, you are, okay. Thank you so much. So is there a last question? Please here, the lady will, the mic will just find you. Yeah, here she is. Thank you so much.
Thank you. Just one quick question. Can you comment on the quality of the balance sheet of the central banks and how's that compared to the US one, for instance, and the consequences of that? Because obviously there's a lot of people in Europe dumping some of their stuff on the central bank.
You know the answer. No? You know the answer. Certainly, the quality has deteriorated almost everywhere. And one wonders if central banks would go public and offer shares, who would buy it. But here, I think also the time horizon, he has already referred to that, has also to be taken into account. Central banks can stand a situation much longer than private institutions. This is an important aspect, and they can always create the money in which they have obligations. So a central bank in the time of a paper standard, not with a fixed exchange rate, has all possibilities. We will see to what extent, and you might have seen the figures, the Fed recently has made huge profit. If you take the balance sheet of the Fed and the federal government together, it's just shifting money from here to there, because the bonds bought by the federal government pays interest, the central bank, the Fed makes profit and transfers the profit to the government. So this is a zero-sum game. Is this a deterioration of the balance sheet? I wonder. But if central banks buy doubtable assets, specific assets of private institutions, real estate, etc., this is something different, which is really deteriorating. And in the case of the European Central Bank, of course, it's not primary assets which are now bought by the ECB. This is also obvious.
Thank you. Well, that's it. That's it. Thank you so much. Professor Othmar Issing. Yeah, thank you so much.
Thank you.